Welcome to the Wealth Transfer Podcast. Today's guest is Nancy K. Phillips, a CPA, certified financial planner, and estate tax specialist with over 35 years of experience guiding families through complex transitions after a loved one passes away. Now, that's not all she does, but that is definitely one of her specialties. That's right, estate tax returns. Nancy's worked alongside attorneys, she's traced missing assets, she's resolved embezzlement cases, and helped clients avoid costly tax mistakes that often follow poor estate planning. In this episode, she shares real stories from the front lines, how family feuds start, what bad wills will cost you, and why the right tax decisions before and after death can preserve both wealth and relationships. If you've ever wondered what really happens behind the scenes of an estate, this episode is a fun one to listen to. Let's dive in. So where I'd love to start though, Nancy, is because you're a well sought after CPA in probably all of Texas and maybe beyond. And I would just love to know, tell us a little bit about your history and how you got into your role as a CPA, as an advisor, and tell us like your history in the industry.
Well, let's see, my dad was a math teacher and I was always good at math. So I put down accounting as my major when I went to college, had no idea what accounting was, but loved the courses and got out, went to work for one of the back then, big 8 firms. Also worked for a major corporation here in Dallas for a while, doing consolidated financial statement, and then went off on my own 39 years ago, very long time ago. So I've been doing this a very long time. And in the last 10 or 15 years, I've liked estate planning and estate tax work. And so I've kind of moved into that area. I don't do really easy little tax returns anymore. I do complicated stuff and love to do the trust and estate work. So I work with a lot of estate planning attorneys who are handling estates, and they send the tax work to me.
That's awesome. Well, so you moved, obviously you were probably doing you were a generalist sort of CPA, you moved into more specific things, and now you've gotten into these really fun estates. In general, what have you learned in doing a lot of estate work?
Oh, wow. I've learned a lot. The IRS is difficult to deal with these days, more so after COVID. I got to tell you about some of the cases I've seen with people with no wills die. I've seen people with handwritten wills who've died. I've seen wills that are bad, so bad that they don't totally define what so-and-so one person's supposed to get. And so there are court cases. So I see a lot of arguments, a lot of court cases, because I'm getting work from law firms. So most of these are contested wills or were no wills at all. For example, I had one, he was a medical professional. He had multimillionaire. He typed up his own wills. And in fact, he wrote 2 on the same date. He signed both of them, never tore up one of them, had a minor difference in a small dollar amount given to one relative in the 2 different wills. Now, he had a second marriage. So, of course, there were arguments over what new wife of 20 years was supposed to get and what kids from a previous marriage were supposed to get. That case, they have now spent over $300,000 in attorney's fees. I don't believe they probated either of those wills because they weren't sure what was the will. They've argued, and what happens a lot of times in these contested wills, they write what's called a family settlement agreement. Have you heard of those? Yes? Okay.
Yeah, tell us more about settlement agreements.
Well, it basically overrides the will. So, I had some bad grandchildren in one case, and they said, hey, he was old when he did this will. He really didn't just need to leave me $10,000. Surely I'm supposed to get a big hunk of his estate, not his wife from a second marriage. She really shouldn't get everything. So everybody hires attorneys. They argue, they go back and forth, and everybody has to sign off and agree to something. And it basically does away with the terms of a will. If there are minor children, they have to be represented by an attorney who makes sure that they're getting a good deal or the best deal they can get. And everybody signs off on this is what we've all decided to do. So I've seen where an illegitimate kid from wherever they decided that that person needed to get some money. And so the other heirs were generous and just said, surely dad meant to leave some to this illegitimate half brother that we just found out about.
So let's go back to this one where they had two wills and it was a minor difference. Was it because he typed them himself, or was it because there were two of them that they had to go this route of contesting it and making a family settlement agreement?
I think it's because he typed them himself, or I'm not sure. That's more of a legal question, but what he did was he used first names in the will. Can you believe people writing their own will? Somebody who has, I was told that he was kind of always underpaying professionals. He didn't want to pay for legal advice and accounting advice. So he did it himself, and he put Tom, Dick, and Harry supposed to get this. We didn't even put last names. And you kind of knew these were a sibling. It was a pretty close relative, but to not put last names, that's crazy.
Well, and that's one of the biggest issues I think we see in these mistake cases is somebody didn't want to pay for professional advice, and then and they paid after their death, right? They're paying more than it would have cost them for the professional advice on the front end for the pain later, right?
Way more. So I saw one case recently. The decedent had a will, and he left a big hunk of his estate to a longtime employee, but he didn't define clearly what that person was supposed to get. And so again, we've got legal fees on both sides. Finally came with they did mediation, and both sides signed a settlement agreement. And I've been told usually nobody's happy because you're somehow having to come up in the middle. So neither side is super happy with a mediation and a family settlement agreement. Let me see. I've got another couple of cases. I've seen a few times where all the money that was in mom or dad's estate is used up in legal fees. The kids get so angry with each other that they decide they're going to sue about whatever, and they use up every bit of the money that was in the parents' estate. I think that's pretty sad. I've seen people, and it's a lot of times they don't want to ever speak to their siblings again. Once you go through hiring lawyers and suing each other and dragging the worst of everybody out, they never want to speak to their siblings again, and that's sad. Where they, could have gone to some sort of mediation quickly and maybe made it through this process a little easier. I see lots of old emotions come out when a parent dies. One stupid example is, hey, brother, I remember when you were 4 and I was 6 and mom gave you some candy one day and I didn't get any. I know mom loved you more than. And you see all these wild emotions come out where they get angry.
What terrible stories we're telling ourselves, can you believe that the candy built this lifelong belief that your mom didn't love you as much as they loved your sibling or something? It's so funny.
Right. And I've seen siblings argue over stupid little things like some figurines on the parent shelf that was there their whole life. They both wanted them, and they both argue over who's going to get them, and they're not worth any money or worth very little. So that's crazy. You have to try to steer your clients to, come on, let's get through this thing.
I always tell people before they die that if they don't plan well, or if they don't figure out how to make things easy to transfer, the siblings are going to fight or the heirs are going to fight. And, 70% of the time the heirs fight. And sometimes it's so much fighting that they never speak to each other again. And it's so sad that that's the outcome after all that.
There's my automatic light that just went out. Oh, it came back on. All right. So let's see. Oh, another case is, I've seen this several times. The child has been maybe caring for the parent and living with them, or maybe they just moved into the parent's house after the parent died, and you can't get them out to sell the house so that the other two siblings can get their share of the inheritance. And finally, an attorney has to step in and kind of evict them almost. I've seen that several times.
Yeah, on the real estate side, we see that a lot. I mean, I think I see that almost, I feel like it's every time, or every time there's an issue. It's easy to deal with it if you don't have this issue, but I see this a lot where they were either caring for them or they've moved in now. And there are some different legal paths. Even in Texas, there's ways that you can, sell even part of your share in the house. If you can't get a sibling out, you don't have to deal with it. But it is a frustrating thing to spend the energy having to get the attorney to solve that for you.
Mm-hmm. And they'll argue over joint land. So I have to tell a real personal story from my family. My parents had, I think they had 12 rental houses, but I'll say 8 because there were 4 kids. So they had 8 rental properties. My mother died first, and I said to my dad, I was helping to handle my mother's estate. I said, Dad, don't leave these 8 houses jointly where I own 1/4 of each of these rental properties. Don't do that to us. And we talked about it some, and we all had a family meeting. He agreed that that would be difficult. We had a family meeting, which lasted probably 15 hours. I mean, so it's 4 siblings and my father. And we ended up drawing addresses out of a hat. And all the homes were about the same value, but we had appraisals because my mother had died shortly before. So we had appraisals. They were slightly different in price. We purchased those homes. Each of us purchased our 2 homes from my dad before he died, and we didn't pay him any money because we owed him. We had a note. We went to a title company. We had a note payable to my father. We purchased and we started taking care of the rental properties and dealing with the tenants and repairs. And, he was elderly and tired of doing that. That worked out really well. So when he died, we had dollar amounts of notes that we all inherited our notes and divided up the rest of the assets.
I love that strategy. That's actually that's sort of one of the strategies we talk to our clients about when we do real estate plans. Because oftentimes, if you've got a portfolio of real estate, it is hard to transfer that, and to transfer them fractionally. Oh my gosh, like it just becomes a major issue. And that idea of selling and then doing notes. Now, one of the other things because you're a CPA in the state of Texas, because your mom had already passed away, you already had the step up in basis, so you could have almost even transferred, even at that time without, and you wouldn't have had to deal with the basis issue or the carryover basis. But sometimes people do this and they aren't smart enough to do a note or to wait till they have a step up in basis, and they transfer straight out too soon. And then now the family got stuck with the carryover basis, and the parents bought it 20 years ago, and the basis is basically nothing because of depreciation. And now they're stuck with this huge capital gain from the transfer of the asset. So you were in a position where you actually transferred it entirely without having to purchase it, and still because you had the carryover or the step up. But maybe you were smart because you got a second step up. You did the notes and then you got a full step up again. Or no, I guess you owned them. You just did the notes.
Yeah, we owned property at my dad's death. We already owned it. So there wasn't a long period of time between my mother and my father's death. So that worked out really well in our case. Another thing that we did to get all the property, found furniture, and all the other possessions divided was to go room to room in the homestead. We listed all the assets in each room. Living room has these pieces of furniture. The kitchen has this stuff. And we put down, we had 3 codes. One, we think it's trash, give it to Goodwill. One, we kind of like it. One, we really do want this item. And so we put what we really wanted in each room. And then we went back room by room, and 2 people really want this item, but the same 2 people really wanted this item. And so they kind of negotiated and picked which items they were going to get. That worked really well. And I saw a will the other day that was similar. I can't remember exactly how theirs was different from our case, but it was very similar, and it was written into the will of how you go through the house and pick items. I thought that was interesting. It was in the will.
We recently, I love that idea. We recently started using a service that it inventories, you take pictures and it inventories from the pictures, everything in the house. And then every family member, so first you can do like the first generation, and then you could even do the grandkids. Every family member can get on the website and it's a round of bidding. And so you have like a certain amount of points and everybody gets to bid. And so you only get to do, you only get so much bidding. And then it's really fascinating how it ends up distributing everything and everything ends up equally. But I love the idea of trying to have rounds of bidding, or I get to assign my point value to this thing, and then I maybe win it or don't win it, and able to divide those things up without a fight.
Yeah. And let's talk about the step up in basis. So Texas is a community property and we get a step up on 100% of everything we jointly own on a husband and wife when the first spouse dies. My parents had all these houses and they got this step up in basis. So on rental properties, when you get a step up in basis, when my mother died first, my dad got to start depreciating those houses again. He had already fully depreciated them because they'd owned them for 40 years. So he got wonderful tax deductions in the couple of years that he had after she died with a step up in basis. And then we also talked about it's not good to get rid of a property before you die. I've had a few people one client I can remember, she owned a home in Highland Park here in Dallas, in the Dallas area. And she had dementia, and her caregivers decided they needed to sell the $1 million, it was a couple of $1 million home before she died to get some money for her care. So $1 million home, she was a single person. You get an exclusion. A single person gets to exclude $250,000 of a homestead from the gain. She'd had a husband who died years and years and years before. So the basis was very low. There was about $200,000 of tax on that sale. The penalties were $60,000 because by the time I got the work, it was past when that tax should have been paid in. Nobody recognized that there was this huge tax, or there was going to be a huge tax when they sold. They could have probably borrowed against it if she really needed the cash for her care. Somebody should have waited. It was like a month before she died, and they incurred a $200,000 tax bill. But I got out of the $60,000 penalty, and I get out of those about 85% of the time.
I love that. Yeah. And I think that's one of the most heartbreaking things to me when they sell right before someone passes and they incur that tax. When like you said, you could have borrowed against it and it wouldn't have been a tax event. You would have been able to get the cash out and then immediately pay off that note a few months or years later and not have to, that's so, or when they sell and they didn't actually need the cash. They thought they needed the cash, but really there's still other assets to draw from or borrow from. Like you didn't actually need to sell this. And that's why I'm almost like on a warpath to tell people you need to pay attention to step up in basis and carryover. If you're going to do an estate work, or if you're going to be thinking about this for your family, you need to be paying attention to what are the tax consequences to selling this real estate. Because there are strategies to, okay, mom just passed. Now is the time to sell, right? Now we can get this money out for dad. Or now, there's different aspects there. So I appreciate you bringing up the step up in basis. Just because I said it and I didn't define it, will you define for us a carryover basis, like what that means?
Oh, okay. So if let's say there's an elderly parent who gives a rental property to their children prior to them dying. I had a friend ask me this question the other day. She said, I've got, 3 rental properties. Should I just go ahead and gift them to my kids? And I said, well, no, you fully depreciated these. You've had them forever. And what they're going to get is a fully depreciated house. They're going to get no tax deductions, no depreciation deductions. They're going to get your cost basis when you're still alive. If you die with it, she's 70 something. If you die with it and they get it, they step up in basis and they can start depreciating them all over again. So they would get an appraisal. Appraisal is the best way of valuing a property. Zillow's nice, but not as accurate as an appraiser coming into your home and looking at it. The Dallas County Appraisal District, the attorneys use that a lot, but it's really usually pretty low and not near as accurate. So that's probably the worst case to use. We've had to get dollar amounts on property that was bought 40 years ago. So we've had clients who have sold property right before they died, and they'd owned it 40 years and big tax. We had to figure out on pieces of land that were worth several $1,000,000. They sold land right before they died. And there's a huge tax. And we had to go figure out when they bought it and what they bought it for. So we've kind of had to do some internet searches on those. We've done several of those.
Well, and one of the things, and I mean, you as a CPA, I'd love to get your thoughts on this because I know some CPAs try to avoid it. But I often tell people, if you're going to sell, we should really be trying to do 1031 exchanges if you've owned this property more than 20 or 30 or 40 years, because then the basis gets carried over to the new property, which might be very little basis. And when you pass away with this new property or new real estate asset, there's a lot of different ways you can hold real estate. Then now they'll get the step up in basis on this new property, but maybe you got rid of the headache that you had, or maybe you got something that's now cash flowing and the previous property wasn't cash flowing. So how do you feel about 1031 exchanges?
I personally have about 14 rental properties. I have done 2 1031 exchanges in my life, and I have had some clients that have done 1031 exchanges. So if you've got a property that you just don't like the neighborhood, rundown neighborhood, it's not a good investment, you can sell that property, identify another house, another property, and have to find a qualified intermediary to hold the money, the sale of the first house. There's a lot of rules. You need a qualified person to explain all that to you. Don't think you can just pocket it, go buy another one. There's a lot of rules. So do it right and get some advice. But yeah, I love 1031 exchanges. And then what I've heard once at a real estate seminar is that the end game in real estate is to die with it, because you do get this step up in basis. And guess what? All that gain, when I sell a rental property, I pay about $35,000 in tax every time I sell one. I've sold one a couple of times, but I've done 2 1031 exchanges, and we mostly just buy and hold them. So,
well, and so you're exactly right, and that tax just eats into the value of your assets, that appreciation or that equity you've built up. And if you can 1031 exchange it, then now you've got the opportunity to keep rolling that, and now it's that money is continuing to appreciate. One of the things that we recommend to people is if you're wanting to do a 1031 exchange, but you're past the age of 60, you may want to go into an asset that's already a little bit more liquid, meaning you could sell it more easily. And so there's other types of real estate assets you can go into. Like, for example, we have some clients that are going into gas royalty trusts, right? So they're 1031 exchanging into that are almost like a market. You can just sell them when you want to. Now you have to still, if you've got a small basis in it, then be careful when you sell. You might have a big gain if you're not doing it appropriately. But you could go into gas royalty trusts. You could also go into Delaware statutory trusts. And are you familiar with DSTs or Delaware statutory trusts?
I've been to some seminars on some of that. I have not had any clients who have done those. I'm not that familiar with them.
Yeah, and so what's interesting is DSTs, the reason that we know about them is because they're the only trust vehicle besides a gas royalty trust, they're the only state trust vehicle that allows you to 1031 into it. And so you actually are a holder of the real estate assets that the DST owns. But a lot of people are going into those because there's about 98 DSTs on the market right now, and usually they're big portfolios, kind of like a REIT that's they own like Amazon warehouses and Kroger retail shopping centers, and they'll own a bunch of assets. And so you have less risk, but you're owning a portion, usually a small portion of the trust that has a large amount of assets. And what's beautiful is every month you get a cash distribution. So they're specifically set up to be cash flowing. And many times when people have owned these other assets, their problem is that they've not let the rents go up, and they're not getting a good return on their equity, right? They've owned it for 40 years and they're not getting nearly the return on what it's currently worth. But if you can take that equity out and put it into something that's now paying you 4 or 5% a month, and you're getting appreciation, now you've got a better cash flow situation for yourself in that time. And then the DSTs usually sell every 3 to 7 years. So when they sell, you can either go into another DST, you can go into a REIT. There's a thing called the 721 exchange. It's an IRS rule that allows you to go from certain DSTs straight into a REIT, or you could 1031 into something else. And what we're seeing with that is DSTs and REITs are immediately fractionalized. So when we're talking about the idea of being able to transfer assets and not everyone having to own portions of each other's rental property, you can immediately start fractionalizing the cash distributions and the ownership of those things to the new heirs without having to deal with the headache of, well, now we have to manage mom and dad's rental together. Now, a lot of financial advisors are hesitant on DSTs because some of them are not great investments. We have a firm that we hire to help us vet of the 98 that are currently available, which 4 are actually good investments or, really solid investments. But there's a lot of cool opportunities with 1031s when somebody wants to sell because they're not getting good cash flow or their assets a headache to them now. But yes, I know a lot of CPAs avoid 1031 exchanges because of the complexity of the rules, but they're a great vehicle for being able to not have to carry over the basis all the way to death, right?
Right. Yeah. Okay. Good information.
Yeah, just this little side thing because I'm so big. I mean, I'm so sick of people paying tax when they didn't need to, and it always breaks my heart. Like you said, the $200,000 of tax plus potential penalties right before death. What are some of the rules around estate and gift tax that people generally need to know or don't know?
Well, the estate tax exemption amount, that means the amount that you can pass along to your heirs, other than a spouse, down usually to your kids, and not pay any estate tax. It's pretty large right now. It's over 13 million. And so this is the largest it's ever been. So it really doesn't affect a lot of folks right now. It may revert back to about 7 million next year. We're holding our breaths. Nobody knows what the exemption is going to be in the year you or I die. We don't have a crystal ball. So my wealthy families, what they are doing is they are gifting to their children and grandchildren if they have grandchildren every year. Currently, it's $19,000 per person per year that you can gift. And if there's a husband and wife alive, each one of them can gift each of their kids and each of their grandkids the $19,000. Last year it was $18,000. They index that with inflation. Sometimes it's not every year, but every other year or two, depending on the inflation rates. So very wealthy family, let's say billionaire, somebody who's a billionaire needs to be doing that every year for every relative.
Are they gifting straight in cash or do they have specific ways they're gifting to try to protect the money?
One of my clients is gifting mineral interest in some farmland that is pumping off almost $1 million of oil royalties every year. So they're gifting mineral interest to their 3 children.
That's fun.
A lot of my families have helped children to buy their first home. So they will gift part of the down payment. But you definitely need to use that $19,000 per kid per year if you've got lots of assets. One client had trust for all the kids and grandkids and was getting appraisals on he had partnerships with just really a brokerage account in those partnerships. And he was giving percentages of the partnerships each year to his kids and grandkids. And he was getting appraisals, which discounted, even though, let's say it was $1 million brokerage account, because it's in a partnership, a family limited partnership, it's not worth $1 million anymore. It's discounted, and maybe it's only worth $600,000. And so he was getting written appraisals, and he would do it in December, and he would use that appraisal in December and then again in January, and was gifting to his kids and grandkids' trusts every year.
Is gifting to a trust that is specifically that they're the beneficiary of, does that count as gifting to them?
Yes, I believe it does. So if you've got a trust that's for 3 grandkids, I think you can get 3 times the 19,000 for that trust. I'm pretty sure that's right. Let me tell you one other rule on selling the homestead after someone's deceased. So mom and dad have both died now. Second one dies, you get a second step up in basis on that homestead or everything that they own. Cattle, land, stocks, bonds, a homestead, everybody's usually got a homestead. When you go to sell that a month after mom and dad have died, you primarily have a loss of the closing cost. We had a new client here recently who thought that she was going to have to pay a huge tax on the sale of the homestead. We're like, no, it's got a step up in basis and you're going to have a small loss. The loss that'll offset other interest or dividends or whatever's in the estate.
That's awesome. Yeah, I wasn't even thinking about the loss of the closing costs, especially if you've got other assets that you might have to pay tax on. We do a lot of, and we were talking a minute ago about ways to get valuations, especially on smaller estates. Or less complex assets where you maybe don't need a full appraisal. We do time of death valuations all the time, where we'll write a letter and provide comparables. And on more complex assets, especially if you feel like you may be subject to estate tax, I recommend getting appraisals because it's nice to have the most solid documentation. But especially if you're underneath the estate tax window and you're just trying to, establish it for a step up in or for a time of death valuation, so that you've got the step up in basis. Because one of the other mistakes people make is not realizing, it's maybe not a big mistake, but they've got the step up in basis. But now if you hold the asset for 2 or 3 years and it continues to appreciate, you've got you need a time of death valuation. You don't need you got to know what was the value at when mom or dad passed, or whenever the final passing was, and then obviously the asset appreciates or in some cases goes down in value and you get the loss there. So yeah, we sent them to do that as well.
And it reminds me of a case where first spouse died. He died and there were a lot of rental properties. So the surviving spouse got an appraisal of all these properties, these rental properties. And yeah, you got this new higher basis. You get to start appreciating these again. And about 3 years after his death, she decided just to dump them all in 1 year. And that put her up into a pretty high bracket. So before you do any major thing, you should talk with your advisors about that. I would have had her spread those out over maybe a 3-year period to keep her from being up in the highest tax bracket 1 year and then way back down into her low bracket the year after.
And this is a little bit of an aside, but there's something about in tax where you have like a professional real estate person versus a non-professional. Is that something? Do you know what I'm talking about?
Yeah, I know what you're talking about. Are you in the trade or business of being in the real estate business? I am not, even though we have a lot of rental properties. You have to have so many hours. And in fact, none of my clients have ever been. I had one that was close and I looked up all those rules and read them, but it's tough to be a real estate professional.
And still have another job.
Yeah, right. So I think that's rare. Well, I want to talk about consolidating accounts. I see this as being a real problem when people die. One case I've been working on for several years is husband and wife both got fairly sick in their early 60s. One with dementia and one with some other medical problems. They had no kids, no family around close. And they ended up with a neighbor, I believe, going to the court and saying, hey, these people need help. Their house is falling around, down around them. They need some medical help. And so the courts sometimes will assign an attorney to take care of his and her financial affairs. And they will also assign a company to take care of their medical needs. So there were 2 attorneys taking care of his and another attorney taking care of her financial affairs. And they both hired me to do the tax returns. A lot of times what I find when people are elderly and are close to death, they haven't filed tax returns maybe in several years. These people had their accounts spread all over town. And these were bright people. They had about 60 accounts, or they owned stock in 40 different companies and had bank accounts all over the place. The attorney's fees, just in my fees, the first year were probably in excess of 100,000. And it's been several years, the attorneys have tried to consolidate and move all the money to one place. There's no reason for people to have accounts all over the place. people think about the FDIC insurance and the fact that they need, they can only have $250,000 in an account. And so that's scary to them. But brokerage firms, correct me if I'm wrong, they have private insurance that usually insures up to like 10 million in an account. Is that what you understand?
If it's a money market, yeah, a cash account. Yep.
Yeah. Okay. So I had another couple. He died, and in retirement, his duties, what he thought was his duties and what he enjoyed doing was, they had 30 different companies of stock that he owned individually. It was not through a brokerage firm at all. So 30 companies times 4 quarterly checks a year, that's 120 checks coming in every year. He was having to endorse those, take them down to the bank. He had long handwritten sheets, all the checks coming in and the dividends. And at year end, it just made the tax return much more difficult. Instead of getting one statement with one number of dividends from XYZ brokerage firm, we had 30 different 1099s coming in from companies. And it just made it very cumbersome. We had to talk.
Or worse, K1s. I have 30 different K1s coming in. Yeah.
Oh, no. I can talk about K1s. They really sometimes complicate the tax returns. Some of my K1s are over 100 pages on some clients on complex investments. And you have to look at every page. So those are difficult investments. Also, oil and gas investments are difficult. But the widow of this case where the husband was recording all these dividend checks, one of the daughters had worked for a stock brokerage firm in the past. And she understood that this was cumbersome and that she needed to fix and do something before mom died. And so she started accumulating everything at, I believe, one brokerage. So, yeah, partnerships are difficult. They're difficult to get rid of if it's not a publicly traded partnership. One of my clients has a land investment, three different partnerships. Small deal with some friends. Her husband bought it 50 years ago. Husband died about 7 years ago. And it's just an inconvenience. She can't get her money out of the deal. They ask her occasionally for real estate taxes and money for mowing the land. And she doesn't have any control over liquidating that asset. So,
in that case, obviously the asset probably transferred to her. Do you ever have these situations where those assets are kind of stuck in the estate and you just have to keep the estate running in perpetuity?
I had one estate. It was a similar deal. It was a fairly small investment, especially for the heir that inherited it was a multimillionaire. So it was piddly for that heir. Just gave the partnership interest back to the folks. Had some wording in their agreement that said he could not sell that to a stranger. You had to have first right of refusal to the other partners. There were some hoops to go through, and he finally just said, you guys take it back. I don't want it. We spent some time looking at it and trying to advise him and realized it was difficult to do anything with it.
Well, this brings me to another section I wanted to ask you about. Like, what advice do you give to families about talking to their heirs or to their children about either their assets or the taxes or their estate planning? Like, what do you recommend to families around communication?
Well, if you've got good children who are not spendaholics and drug addicts, you need to include them in discussions about what your assets are. Sit down and go over a list of your assets. I had my son do our personal tax returns. He knows where all the assets are and what we have, where everything is. So I think when children are maybe under 21 to 25, if you dump a lot of money on a child that's younger than that, they may not make wise decisions with it. But once they get over about 25-ish, 27, they've kind of established how they're going to spend money, how they're going to save money, and they have a good grasp of all that. So I think people need to include them in their discussion.
Do you have any situations or stories when someone's passed away and the kids didn't know what the the family had or didn't know about the assets, or they came to learn about it all after the fact?
Oh, yeah. I just did a large estate, and the kids argued, and, they did a family settlement agreement, but they changed executors in the middle of all this family settlement agreement. And the daughter who took over, she didn't know what assets mom had. Mom had never shared that with her. So I see that all the time.
And do you recommend to your clients, or obviously you're getting a lot of clients after the fact, but do you recommend that people, should they keep how should they track a balance sheet or a list of assets?
Well, how they track, I don't know. I'm an accountant, I'm a CPA, so I do an annual balance sheet for myself. Most people have a financial planner that they go meet with maybe once a year. Take your child along if they're grown. I started taking my son to real estate closings where we bought real properties when he was maybe 13 or 15. Had him just sitting at the table where I was signing all the documents, buying a home. So he got used to what a closing was like, and what settlement statements looks like, and what contracts look like, real estate contracts look like. You just train them when they're kid as best you can.
I love it. So it seems to me like you've got a great point. Like there's certain things that you should bring them into earlier on so that they understand just finances and money and taxes. And then there's maybe some things about how wealthy you are that you can bring them into later as they get a little older. But either way, starting early so that they can be responsible and be good adults that can manage those things. But don't wait too long. Don't wait until you've passed away for them to figure it all out.
Right. There's a form. It's still on the tax returns. When you've got a child who's under, I think, 21, and they earn above the kiddie tax rolls, when they earn above a certain level, they're taxed back at the parent's rate. Is to keep wealthy people from putting oodles of money in kids' name, and the kids only at the 10% bracket, partly at the zero tax bracket. So I've had a couple of clients who did not want, I did the parents' return and I did the son's return, kids' returns, and that page with the parent's income is supposed to be on the child's tax return. And the parent did not want the child to see their income. Yeah, they said, pull that page. We do not want, and I said, well, your son's 18 now. He's grown. He needs to sign his own return. You can't sign him as a parent when he was 17. So, yeah, they didn't want kids to see their income. These were incomes over $1 million a year.
Sure.
So.
Yeah. Well, Nancy, obviously you specialize in a couple different things. If someone wanted to hire you, or if they wanted to send you a referral, what types of opportunities would be best to send your way, or who should be calling you to get your help or your advice?
Well, I love working with families or professionals who they've had a death of a client or a death in the family. And I help lead them through how all these rules work, how the tax returns work, how best to, if you have an option of paying professional fees in December or January, which year is going to be best. Sometimes I talk the professionals into waiting until January to get their money because there's income in that year and there's no income in the other year. And the deduction just going to be lost. So yeah, I just like working with the states. We also do complex tax returns for family groups, like the guy who had trust for all the kids and grandkids, family limited partnerships, maybe a corporation. So some complicated tax work, not just one easy personal tax return.
No 1040s, unless they're attached to a bunch of trusts and LLCs.
Yeah, attached to something else more difficult. Yeah.
That's perfect. And is there a website that people can go and submit inquiries to?
Yeah. You just Google Nancy Middle Initial K Phillips, CPA, Dallas, Texas. You'll find me.
That's perfect. Well, Nancy, we'll make sure to send some clients your way, and hopefully some of our listeners will as well. And I really appreciate you coming on and sharing some stories.
All right. It's been great fun.
That's it for today's episode of the Wealth Transfer Podcast. If you found value in this conversation, would you leave us a review? That would be just So honoring to us. We'd appreciate it. And if you know somebody who might need to listen to this because they're thinking about their next chapter, will you send them a link to this podcast or this video so that they can listen more as well? For more episodes and expert insights, be sure to follow and subscribe. That means the most to us. Follow and subscribe, please, please, please. And when you're ready to take action on your own real estate plan, or if you need help with wealth transfer planning, we know a number of experts in all the different spaces. We'd love to connect you with them. You can reach out to us via direct message or comment. You can email us, matt@templeton.realestate. No .com, just templeton.realestate. And I'd be happy to connect you with an advisor. Thanks so much.